Let's bring on board the management of Eclerx. We have Srinivasan, the CFO of the company, joining in with us. A very good afternoon, sir, and thank you so much for joining in with us this afternoon.
Thank you.
Obviously, firstly, I want to talk about, in terms of the company's growth, the strategy. What could we be expecting in terms of that? Because now what the street is expecting is that we could maybe see a very soft Q1 due to some of the revenue headwinds, the possibility of, sequential revenue dip in Q1. What has been the reading so far for the company?
So you're right. We do expect a soft Q1. There is possibility that there will be a sequential dip quarter on quarter. And I think in large part that is owing to the uncertainty in the macroeconomic environment in developing economies where most of our clients are. But we do expect that if that uncertainty gets resolved as it seems to be getting, we do expect that in H2 of FY24 should be a better year and we should be back on the growth trajectory.
Okay, so H2 could be a better year, is what you're saying. But in terms of just for FY24, is a double-digit growth on the line? Is that something we could expect from the company then?
I think that would be very difficult. And that's because, H1 sets the tone for what happens in the other three quarters. And if the H1 is soft or is lower than Q4 of the previous year, then catching up becomes difficult. So I would say it would be difficult to have double-digit growth.
To have a double-digit growth, but at least a recovery is what we could see. A better improvement in terms of H2 would be better than H1 is what you're saying. And if any indication in terms of number that if you'd give that, what would you be expecting for the year end then?
No, we don't usually give guidance, so I'm unable to give a specific number. But we do, what we want to target is that the Q4 exit run rate is good enough to that we target double-digit growth in FY25 onwards. So our hope is that, and our efforts are towards ensuring that we are able to get back onto the growth trajectory and have a good enough Q4 that serves as a launching pad for FY25.
Sure. Also, sir, just in terms of client conversion, if I want to understand that, how was the client conversion happening in the last 3-4 months? Is it moving on the positive side or remain the same as we saw in Q4 or a bit on the negative side? What's the view there?
So at least in Q4 and a large part of Q1, it has been slow. There have been cuts from the client side on the budgets that they spend with us, and also in terms of the time that they take to make decisions. So wherever the spend is discretionary in nature, I think the time taken for conversion has increased. We are seeing some signs that is coming back to normal, and hopefully, as the year progresses, it should be back to original levels.
Okay, and also if I want to understand, what is margins looking like? In Q1, there is a seasonality and impact on margins as well. Could you help us understand this and quantify this historically? What would have been the impact and how is it looking like?
So usually the impact of wage hikes, which are annual and paid out in April, is about 250 to 350 basis points of revenue. And we expect about the same impact in Q1 as well. What works in our favor is that supply side constraints are no longer as tight as they were the same time last year. So the same in FY23, we were dealing with a lot of attrition issues. We were dealing with, because of that, we had higher benches. I think wage increments were much higher than normal. We had to pay a lot to get resources on board. Some of those conditions have eased up, so we don't see attrition being a significant issue, and therefore we feel that the chances of us being able to recover the wage increment are higher.
Okay, sure. I just want to also know in terms of supply side issues, in terms of the headcount addition to space, or even in terms of when you look at the level of utilization and outsourcing, could you just highlight anything in terms of that? Are there any concerns on that front?
So between Q3 and Q4, there was a decline in headcount. There might be some decline in Q1 as well, or maybe it will probably remain the same. Utilization, I think we are about where we are, and we think that will probably be flat or maybe marginally up now.
Also, just in terms of, if you could just say, 70% of your business actually comes from US and 20% from Europe. So what is the trend shaping up in both these territories specifically? Anything different that you're seeing?
Europe seems to be doing fairly reasonably well. I think a large part of the revenue for Europe for us comes from luxury clients, and they are holding up pretty well. We think that business is doing okay. Our retail, e-tail, and high-tech clients, those are mostly based in the US, and there we see some kind of pullback in spending because of discretionary budget cuts and the reasons that I spoke about earlier.
Okay. Just one last thing. What are the conversations that you're taking with your client? How is that shaping up like?
I think though it was slow in Q4 and in Q1, we think that clients are now starting to get back to the table. They want to talk about Gen AI. They want to talk about spending a little more on analytics and automation. So we do see that some of these conversations have resumed. So that's what it seems like.
Thank you so much, Mr. Srinivasan, for joining with us this afternoon on ET Now and giving us an understanding on the company.
Thank you.